When thinking of infinite banking, what strategy comes to mind? Is it IUL or is it whole life? In this episode, we're going to talk about the topic of infinite banking from IUL to whole life. Get ready. My name's Justin Smith, and I've helped educate thousands of people of how to now outlive your money during retirement and how to also use that savings account to invest in things like a business opportunity or even real estate using the max funded life insurance contract. So why do people overfund their policy? So what we're going to do is we're going to explain the difference of why, given the basics of universal life, index universal life, and whole life. We're also going to talk about why an IUL, index universal life policy, can also be better for you than a whole life policy in some situations. For starters, when it comes to life insurance, there was only two types. You had term and you had whole. When it comes to term life, you're basically paying for the cost. So if you were to die within the term of 10, 20, 30 years, your heirs or your family will get a death benefit deposit. So based on a mortality table, you're basically paying based upon your health and your age. Term insurance is not generally something you would run to accumulate cash. In order to win with term insurance, you have to die. Term insurance is also something that gets more expensive when you get older. So this is something I suggest you get when you're younger. And if you need help with that, we can also do that for you. Now, that didn't really seem fair to only be covered or insured for a certain term of your life. So this is when the concept of whole life came about. People wanted to be insured for the whole life. They didn't want to keep paying or keep adding on premiums when they get older to the point where they can't even afford them anymore. Now, with whole life, what they tell you is we want you to pay higher premiums or basically overpay your life insurance in the earlier years so you can build up a cash value in the later years. Now, when it comes to being a whole life policy, that premium is basically leveled through the whole life. So the cash value that you build up in that policy will start to earn interest. And when it earns interest, it gets to the point where the interest or very minimum of your premium is actually going towards the life insurance and the rest would go to the cash value. So basically you overfund in the earlier years, and then the later years, that interest that you're making will basically cover the premium of the life insurance. So studies show that since the 80s, whole life insurance interest rates have been around 4%. Now, whole life sounds great because it's structured to give you those guarantees. The only downfall is in a low interest life where the banking institutions and the federal interest rates are around 1%. It'd be pretty hard for these insurance companies to be able to cover your whole life, giving you that annual 4% every year when they're not even getting that 4% anymore. This means this strategy has not become in favor of some of these insurance companies, if not most. Which also leads at the end of 2020, what was a part of that big stimulus legislation, changes to Section 7702 in the Internal Revenue Code. Please lock in for more episodes of this. But this means it took the guarantees down to 2%, meaning the guarantees inside of a whole life policies are 2%, meaning they're not that effective anymore. Now, this means whole life has to perform up under dividend. This also makes it possible for the strategy of indexing in universal life to perform much better than whole life will. Now, this is in regards to historical rates of return. But if you are using life insurance for the be your own bank concept, I believe that index universal life will give whole life a run for its money. Now, if this topic is something you want to learn more about, please subscribe to our YouTube channel where we have videos about this every week. Now, when it comes to whole life, people will say that whole life will win every time because of guarantees. But with new rules and as it evolves now, you might want to stay to the end of this video to see how you can benefit from this and why I think index universal life is better for you in the long run if you want to accumulate tax-free capital. Now, if all you want is a death benefit, whole life is a great product for you. Not to mention universal life can also do this, but with universal life, you're self-insuring. Meaning if you were to put $500,000 in and the required insurance amount for this to be tax-free for a 60-year-old is what, $1.2 million. This means at a rate of return of 7.2, that $500,000 will be $1 million in 7 to 10 years. And then in another 7 to 10 years, you'll already be at $2 million. At this point, you really don't need a whole life policy because you're self-insuring that death benefit. This is according to the TEFRA and DEFRA tax citations, which I explain in other videos. And I also have a mini course in the link below that'll explain this a little more for you. Now let's talk about why people would consider life insurance to create their own banks. For over 100 years, life insurance has always been a sleeper. I mean, slept on. In the Internal Revenue Code under sections 7702, 72E, and 101A, it explains that the money inside of that life insurance contract can grow tax-free, transfer tax-free, and also be accessed tax-free. Index Universal Life came out in 1997 and it was created by E.F. Hutton. This concept came out during the buy term, invest the difference concept, but it's on steroids because this is tax-free. It's the same thing when you use the Index Universal Life for infinite banking. It's on steroids. So when it comes to TEFRA, DEFRA, and TAMRA, they're tax citations. Like I said before, under section 72E, 7702, and 101A, when you put your money into a life insurance policy and you request to have the smallest death benefit that the IRS allows, you're able to grow your money tax-free, access your money tax-free, and also transfer and also blossom your money tax-free when you die. Now, the reason it's been slept on is because when you think of whole life insurance, it's often used for infinite banking based on when you build up the cash value, you're guaranteed that 4%. You borrow money from your whole life policy, they charge you a 4% or a nominal rate, and then they also credit you a little bit higher than what they charge you. So this means if I were to borrow at 2%, they may guarantee me about 4%. But with the interest rates dropping to 2% guarantees, so this doesn't make a big deal, nor has it ever with Universal Life. This is because I would not need the guarantees of life insurance anymore because my cash value will grow to the equal amount of the death benefit. As long as I keep the death benefit about 5 percentage points ahead, I should be good. So if I have $2 million in cash value, that means my death benefit will have to be $2.1 million. Now with Index Universal Life, it gives me two ways that I can borrow the money. Number one is called zero cost or zero wash loan. So let's say I have $1 million of cash value. Now it don't matter if you have 100,000 or even $10 million of cash value. People use the banking concept for insurance to buy real estate, for working capital in their business, and much more. Now, if this concept seems a little foreign to you, I have plenty of episodes on this channel that explains how to become your own banker. So let's go back to having $1 million in cash value. If it was a whole life policy, they would credit me a little higher interest rate, and I'm paying myself interest as I put money back into the policy. Now, there's no problem with being charged 2% if I'm getting 4%, because 4% is 100 times more than 2%, but the guarantees are going down. Now with Index Universal Life, I can be charged to and credited to, and it causes that zero wash loan, crosses everything out. But you can also opt into the indexed or participating loan. This is where you're leaving your money in the insurance contract as collateral so they can credit you whatever the index is earning that year. To keep it simple, let's say I'm earning 10%. Now with this being a participating loan, they may charge me a higher interest rate, so they may charge me 5%. So on that $1 million, they're gonna charge me $50,000. Now this is nothing I have to write a check out for or pay physically because they would deduct this from my cash value or my death benefit. Because if I earn 10% on my collateralized million in the policy, that means I'm earning 100% more than the cost of funds. Now this is something that can strongly compete with that whole life 2%. Now, when speaking in terms of a spread, the difference between the net amount that you're borrowing and the net amount that you're earning on this compounding interest, if you keep earning 100% more than they're charging you, this is going to compound and grow tax-free. Before you know it, you'll be earning that example 10% money on double the amount of money that you're paying interest on. But as it grows, you can still keep borrowing more money. This means it keeps getting better and better as it goes. So if infinite banking or becoming your own bank is something that actually interests you, I can gladly show you an illustration on why Index Universal Life is infinite banking on steroids. Let's not make the mistake of learning of something that's good without even knowing about what's better or even the best option for you. By the way, if you're liking this video, be sure to subscribe to this channel because we drop bombs like this every week. Also, if this is something that you're very interested in and you want to see it on paper, check the link below. Check the link in the description. I have a free ebook for you. My team and I created a free ebook for you. Go ahead and download the PDF and learn as much as you can from start to finish of how to become your own bank. My name is Justin Smith. This is the Investments YouTube channel, and we'll see you next video.